Ladies and gentlemen, good day and welcome to the earnings conference call of Usha Martin Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devrishi Singh of CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Usha Martin's Q3 FY24 earnings conference call. We have with us Mr. Rajiv Jhawar, Managing Director of the company, Mr. Anirban Sanyal, Chief Financial Officer, and Ms. Shreya Jhawar from the Strategy and Growth team of the company. We hope all of you have had the opportunity to refer to the earnings documents that we shared with you earlier. We would now like to initiate the call with the opening remarks from the management, following which we will have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation. I would now like to invite Mr. Rajiv Jhawar to make his opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of the management team of Usha Martin, I would like to welcome you all to our earnings conference call. I will begin by sharing quick operational and strategy-related updates of the company, following which our CFO, Mr. Anirban Sanyal, will run you through the key financial highlights. I am pleased to report that over the first 9 months of the year, we have made healthy progress on our strategic growth initiatives. These include 1. Continuous enhancement of our product portfolio with a focus on value-added offerings, and 2. Strengthening our capabilities through CapEx planned initiatives. During the recent quarters, there have been pricing pressures in our wire and strand and LRPC segments, which has had an impact on the revenue performance. Despite that, we have shown resilience, managing to maintain stable top-line performance on the back of strong support from our core wire rope segment. The contribution of wire rope segment to our consolidated revenue has increased to 70% in the 9 months FY24, up from 67% in FY23. Simultaneously, the share of value-added industry segments in our consolidated revenue registered growth, reaching 49%, up from 44% in FY23. It's worth highlighting that within the wire rope category, the contribution of value-added segments increased to 70% in 9 months FY24, up from 65% in FY23. Additionally, during the same period, revenue from international markets constituted 55% of our total revenue. Despite the volatility in steel prices, our wire rope realizations have consistently shown an upward trend. This positive trajectory is particularly noticeable in our value-added wire rope products, which demand substantial engineering expertise. This has helped improve our profitability, with our operating EBITDA and PAT registering a healthy growth of 23.7% and 27.9% respectively. In this financial year, our focus was on value. From next year, we will do value-led volume growth. So, looking ahead, our first wave of capital expenditure, that is phase 1 expansion in Ranchi, is set to be completed in Q4. This phase includes the increase of capacities for higher value-added products such as crane ropes, compacted ropes, plasticated ropes, oil and offshore ropes. Furthermore, our CapEx initiatives include the modernization of existing production facilities aimed at enhancing our infrastructure. We believe that these investments will further strengthen our position as a leading global player in the wire rope sector. I would also like to take this opportunity to give updates regarding a few important growth initiatives taken by us. Number one, we have set up a step-down subsidiary company in Saudi Arabia through our Dubai subsidiary, Brunton Wire Ropes, to target the growing Saudi market. Two, our Thailand subsidiary, Usha Siam, recently acquired the remaining 50% stake in Tezak Usha. Previously, it was a 50-50 JV with Tezak Wire Rope of Japan. We will use this facility for the manufacture of high-value elevator ropes. Number three, we are planning to enter the synthetic slings market through our UK plant, Brunton Shaw, UK. This will be our first foray into the synthetics space. In addition, Usha Martin is actively pursuing various internal initiatives that will continue to contribute positively to its operational and financial performance. Firstly, the successful integration of our international businesses with the Indian operations is encouraging growth synergies and creating a more integrated and collaborative approach across our global and local teams. Secondly, to support our constant commitment to strategic growth, we have established cross-functional groups for our key growth segments such as mining, elevator, fishing, and structural, maximizing our impact in these critical areas. Furthermore, our dedication to a one-stop shop approach with an intensified focus on services is actively contributing to an overall enhancement in customer satisfaction. Going forward, we are confident that our efforts in this initiative will help position us as a comprehensive solution provider in the wire rope sector. Lastly, the continuous strengthening of our international teams and organizational structure is equipping us effectively meet the unique demands of a diverse market. In conclusion, I want to highlight that presently our company is dedicated to its strategic initiatives and leveraging its fundamental strengths in the face of the global market environment. We are confident that our sustained efforts will yield positive results, playing an important role in driving sustainable growth for Usha Martin. With this, I would like to hand over to Mr. Anirban Sanyal, our CFO, who will present the operational and financial highlights for the quarter and 9 months ended 31st December 2023. Thank you.
Thank you and a very good afternoon to everyone. I will now provide a brief overview of the company's operating and financial performance for the quarter and 9 months ended 31st December 2023. The consolidated net revenue from operations stood at rupees 797.1 crores in Q3 of FY24 as against rupees 833.6 crores in Q3 of FY23. This 4.4% year-on-year dip was primarily owing to a reduced contributions from both the wire and strand and LRPC segments. Notably, our wire rope segment sustained steady revenues despite registering a year-on-year reduction in its sales volumes. This segment's increased realization played an important role in supporting our overall revenue performance during the quarter. Our operating EBITDA for the quarter showcased a healthy 23.7% rise on a year-on-year basis, reaching rupees 157.1 crores. Additionally, the operating EBITDA per ton demonstrated a notable 33.3% year-on-year improvement at rupees 34,000. The Q3 FY24 operating EBITDA margin rose to 19.7%, up from 15.2% in Q3 of FY23. The company's sustained emphasis on value-added products and its expanding global presence played an important role in enhancing our overall margin position. Our net profit for the quarter stood at rupees 107.5 crores, registering an increase of 27.9% from rupees 84.1 crores in Q3 of FY23. On a 9-month basis, net revenues from operations stood at rupees 2,396.2 crores compared to rupees 2,412.5 crores during 9 months of FY23. Operating EBITDA stood at rupees 447.1 crores in 9 months FY24 as against rupees 359.4 crores in 9 months of FY23. Profit after tax for 9 months FY24 stood at rupees 317.8 crores, registering a 29.6% year-on-year increase. Our balance sheet position continues to be strong, with our net debt to equity ratio improving to 0.05 times as of December 2023. Despite a capex spend of approximately rupees 196 crores in 9 months of FY24 and the allocation of funds for dividend disbursement, our net debt remains at comfortable levels. We have increased our inventory levels to be well prepared for the anticipated increase in demand in the coming quarters, while also considering the challenges posed by global logistics amid the current volatile geopolitical climate. This approach helps us to efficiently meet the requirements of our expanding customer base, particularly new clients, ensuring we remain responsive and well prepared in a dynamic market environment. Coming to our cash flows, there has been a healthy year-on-year improvement in our cash flow generation. The cash flow from operations before income tax for 9 months of FY24 stands at rupees 420.3 crores and at 94% of operating EBITDA compared to rupees 214.5 crores during 9 months of FY23 and at 60% of operating EBITDA. Our robust cash flows, coupled with ample headroom on working capital lines, will continue in supporting our planned capital allocations. In conclusion, I would like to emphasize that given the promising demand outlook for our products and our dominant position within the sector, we are committed to maintaining strong financial discipline. We believe that our thoughtfully planned business strategies and proactive initiatives will continue to play an important role in maintaining and further strengthening our leadership position. With favorable industry dynamics and Usha Martin's inherent strengths, we are confident in achieving sustainable growth for all our stakeholders. This brings me to the end of my address. I would now request the moderator to open the line for the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Aman Kumar Sontalia from AK Securities. Please go ahead.
Good afternoon, sir. Sir, congratulations for the excellent set of numbers despite we have limited capacity. And sir, I have few questions regarding future outlook of the company. Number one, sir, what is the update of expansion and when can we expect the expanded capacity to start contributing to the bottom line of the company?
As I mentioned, the phase 1 capacity expansion is getting completed within the Q4, within the next 1 month. And this is a brownfield expansion at Ranchi, which is getting completed. And we expect the volume start coming in from, I would say, Q1 of the next financial year. Having said that, the ramping up would take, we'll start the ramping up from Q1. And depending on how the demand picks up and how we are able to push our volumes, we will definitely see the benefits coming from Q1 of the next financial year.
Okay, sir. Sir, next question. In the last 2 years, we have supplied ropes to big ticket clients in Europe and in USA. Now I hope they will be assured of our quality and capabilities. So can we expect big repeat orders coming from the big clients?
Yes. So we have started getting more business from the premium customers that we were able to secure in Europe and the US as well. Just to give an example, our Brunton Shaw UK business, it does continue to see strong growth this year as well. And the current year, we forecast it to show growth of 30% compared to, what we did last year at BS UK. And the major growth, like you said, has come from, the Ocean Max, Crane Max brands, which are supplied to the high-end customers, like you mentioned. Other than that, we're also targeting elevator ropes, and we have been successful and now approved with suppliers of major OEMs in Europe, even within the mining rope segment in the US, and also in Europe now. We're seeing great development, especially with our Mine Max brand, and we have been able to win key contracts. So with strong collaboration with all of our European entities, along with the Global Design Center, and offering customers with a one-stop shop solution rather than just supply of the products, that has helped us develop these relationships with the major customers and, helps us continue to gain this business.
Okay, thank you. Next question is, high-end wire rope is critical and we have low cost advantages. However, where does the company score over competitors in the international market like Brunton Shaw and Wireco regarding quality and branding?
You see, as we mentioned that we have been able to develop through our collaboration or with close working with our international subsidiaries and the parent company, where we get the cost advantage of low-cost manufacturing compared to what the Europeans are and the Americans are through this integration between the wires and strands being supplied from India and taking advantage of our manufacturing facility in Europe, and also with our design center, our development center in Italy. We definitely are more competitive and are able to gain market share. So this is definitely going to happen with this close integration between the two entities, and that is how it is helping us to get better market share as well.
Sir, one more question regarding this Saudi Arabia, sir. When can we expect a contribution from this venture, and how ample is the opportunity? And are we planning to set up a plant there?
With regard to Saudi Arabia, so we have set up this step-down subsidiary through Brunton Wire Rope, and we will provide, as part of the entity under the EMM brand, we will provide value-added services there for ropes, similar to our other service centers that we have in Europe right now. And we plan to cater to, all the value-added segments, oil and gas, ports, cranes, construction and infrastructure. As well, we see a massive opportunity there. And I'm sure with that there will be demand for general engineering ropes as well. So that is something we will also cater to. In terms of timelines, we do expect to start the operations in Q1. The teams are ready, as well as the equipment has been ordered. And at first, on the question on the plant setup there, at first it will be a service center, like I was mentioning, for value addition for ropes such as cutting, coiling, socketing, testing, and so on. And of course, also it will be a stock point for distribution and supply to customers in Saudi Arabia. And our goal is that we want to start this way, and eventually we'll get to study the market a little bit better, and we'll get some traction in the market, establish our track record there as well, and then consider further expansion. But it's early days right now, so we'll see how things progress first. Yeah.
And one last question, madam. Sir, the outlook of LRPC is not looking very bright. So it's a commodity, and in LRPC neither we have pricing power nor leadership. Sir, are we planning to exit this business and put our energy into core wire rope business where we have both pricing power and leadership?
You're right that LRPC is right now, last few quarters, we have seen the margins coming down considerably, and with big players, competitors having their own steel, have been able to aggressively push volume to the market and thereby with very, very low margins. Having said that, we are focusing on getting into value-added LRPC, which is galvanized LRPC, plasticated LRPC, PVC-coated LRPC. Of course, the quantity and demand is project-based, and we have got some good orders. Our products have been well established, but I would say that the ramping up from a demand perspective may take a few quarters, but that is definitely going to be one of our focus areas. We would continue to supply the LRPC because it is still adding maybe lower margins but still adding positively to the overall profitability, and it's an independent plant. Having said that, we would also look at opportunities that using the wire drawing and patenting facilities, which is part of the LRPC line, how we can get into other value-added wires, which can add much better contribution, within the domestic market, exports, and even through the Brunton Shaw UK, how much we can do that. So I would say it would be a few difficult quarters with the LRPC overall margins, but I am sure that with these initiatives, we should be able to see a better margin from this facility.
Okay, sir. Thanks a lot. Thanks. That's from my side.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. My first question was on the volume growth for next year. If we look at on a quarterly basis, our wire rope volume has cut between 23,000 to 25,000 metric ton per quarter for the past 6 quarters. So how do you see the growth in volume growth in the wire rope segment for FY25 once the new CapEx comes on stream?
As I mentioned, the new CapEx is getting commissioned in Q4 completely. It was a brownfield expansion which requires addition of new machines within the setup, as well as upgrading our patenting facilities to increase the volume, and a new pickling house. All of that is getting commissioned in this quarter. I would say that next year, looking at the volume growth, I would say that we should be able to get at least 15,000 tons of extra volume of ropes coming in. We would definitely aim to go even higher, but looking at the demand market and also a little bit time taking for the specialty products, it may be plus minus some quantity, but I would say that at least it would be 15,000 tons more than what we did this year.
So, and it will be largely for specialized applications like mining, port cranes, etc.?
We would push towards that, and as these markets take some time to develop, it would be a combination of these special products as well as GP ropes through our own distribution facilities where we add value to that. So it would be a combination of both.
Sure. So my second question was on the subsidiary performance. So if you look at the performance of this quarter, if we remove standalone performance from consolidated performance, we've seen a considerable dip in the performance of our subsidiaries for this quarter. Like this performance in terms of revenue and profit is lower for is the least in compared to the last 5 quarters. So what has led to this decline in performance of subsidiaries? And one request we had put in last call also is to give some brief or some financials in the presentation for each of the subsidiaries. That will be helpful.
I think the overall performance has considerably improved compared to the previous quarters. In fact, our EBITDA per ton has been the highest in this quarter compared to the last few quarters, with a constant growth every time. While the volume has been flat, what we mentioned that going forward, we should be in a position to get to 15,000 tons extra, which will definitely add to the revenue, increase the revenue also in the coming quarters. As far as subsidiaries is concerned, I think all the international subsidiaries have performed well, and all of them have had decent growth. And I would say that that is something which would continue to happen, and they work very closely with the parent company, and we expect them to continuously contribute to the overall profitability of the business.
Okay, because sir, if I was just deducting the standalone performance from consolidated performance, and if you look at those numbers, that has been showing some decline in revenue as well as profitability. Maybe some transfer pricing might have happened in standalone, because standalone performance has improved significantly in this quarter, and consolidated has little bit has seen some pressure on like in terms of revenue growth and all.
We look at the business on a consolidated basis. We don't look at it standalone separately and the international business separately, because this is one business entity, and sometimes one particular subsidiary may be less or more, but I would say that the overall profitability has improved by almost 23 and 30% if you look at it from quarter on quarter. So we actually don't track we track the businesses, individual businesses, but when we look at it as an integrated, we look at one consolidated balance sheet and not break it up into individual components.
Okay. And my last question was on the margin side. We have seen a significant uptick in margins in the quarter with EBITDA margins touching almost 20%. So, is it a one-off quarter, or do you think 20% kind of margins we should continue to maintain in FY25?
Our endeavor would be to continue to maintain and grow our margins with more and more volumes of wire rope coming in with the new capacity expansion, more towards the wire rope side. So I'm sure that going forward we should expect the margins to be, and we had also even mentioned that we would endeavor to go towards 20% and then gradually push it up. So we are on track, and as I mentioned in my address that we have been able to successfully create a value-led growth in this year, and going forward it will be value-led volume growth. So we expect the margins to be stable and also hope to get the advantage of higher volumes, giving an overall better performance in the subsequent quarters.
Okay, because normally in a earlier calls I have indicated that our margins will remain around 18-19%. So this time, given a performance, and you are saying that we can even do 20% plus kind of margins going forward.
I mean, like we said, that the quarter-on-quarter variations may happen again based on product mix, volumes, various external dynamics. But overall, our focus is to grow the absolute profitability and also to maintain the healthy margins. Sure.
So last question is on the Saudi Arabian market. So how big are this market, and what kind of volume can we expect from this market over the next year or two?
You see, we are currently, Saudi Arabia is a very growing market based on all the feedback which we get and our survey which has been done under the new Crown Prince, who is taking major initiatives of new infrastructure and growth in the oil as well as on the ports, the infrastructure, and few of large projects have been announced. Currently, we are selling through our Indian operations as well as through our Dubai almost about 1,500 to 1,800 tons per annum. Having our own setup over there with our own marketing team, combined with the growth opportunities, we expect to grow reasonably well in the coming quarters.
Sure. Okay. Thank you so much. This is all the best.
Thank you. The next question is from the line of Kunal Kothari from Centrum Broking. Please go ahead.
Yeah, thank you for the opportunity, and congratulations for the set of numbers. Sir, as you mentioned that there was a dip in the realization on the LRPC segment, while our wire segment is doing well. So I would like to understand from you what variables that we can track properly to understand the changing business environment for the products that we are in business. So to get a fair value of understanding that the coming quarter will be better, the coming year will be a little bit softer because of the so and so change in dynamics. So what exactly that can help us to understand better the business dynamics of our business?
The prime driver is always going to be the growth in the wire rope business, because that's our core business. The LRPC lower margins have already been factored in this financial year. I would say in the last 3 or 4 quarters, the LRPC margins have been subdued, the prices have been subdued, and I've said that this is because of the increased volumes by the steel-backed manufacturers. Having said that, going forward, I would say that our profitability would be driven by the wire rope part of the business and how much we are able to convert the LRPC into plasticated LRPC, galvanized LRPC, and also looking at other types of LRPC where higher tensile products can be provided, particularly in the export market. So those are definitely going to overall improve the profitability coming from the LRPC sector. And I would say that the growth going forward is going to be from the wire rope side, where the new capacity expansion is going to give us increased volume of at least 15,000 tons in the next financial year once the capex which is completed now. So that is also going to help the value-led volume growth with a continued focus on the specialty wire rope business, and of course with the new initiatives which we have talked in Saudi Arabia, and also expanding our integration with our international subsidiaries. So I would say this is the way we would continue to improve our financial performance in the coming and in a way we are insulating or hedging our business and not depending on the LRPC business, which could have a good quarter, a good year, depending on the overall demand and supply, or could even be subdued. So I think it has already been factored in our performance in the last 2 or 3 quarters.
Let me frame my question better way. Right now we are doing nearly 20% of margin. What variables or factors which can can have an impact and lead to the margins fall to say 15-17%, or what factors or it can take to 25%? Can you help me to map it out in a simpler way, that these are the factors that to be keenly understand well, that that is important for a company?
You see, as far as again to be very specific to you, this 20% what we have been able to achieve, going from 15 to 20% is by continuously focusing on the wire rope business and improving the product mix and going into more value-added businesses, including integrating with our international businesses, which deal with absolutely high-end customers and which fetch us a much higher realization. So based on this, we have been able to achieve this 20%, and this is after factoring that the negative margin which we have or a fall in margins in the LRPC. Going forward, I would say that if you want to really see that with these margins of LRPC, can we maintain this 20% margin? I will say yes, it is possible to do it based on the work which has already been done, and it is reflecting in our margins. Going forward, if LRPC gives us better margins through the galvanized or plasticated, it is also going to contribute a little bit to the bottom line. Going forward, getting to 25%, I would say that it is going to take a while, and with all the various initiatives, but I'm sure that the company would continue to focus on the journey of value addition as well as the increased volumes, and hopefully we should do even better going forward.
Okay, sir. So last question, as we are doing a capex right now, So right now, what is our overall capacity segment-wise and post CapEx completion, both phase one and phase two? How much capacity will be added?
We are in phase one and phase two together, we are adding 45,000, between 45 to 50,000 tons of capacity increase. Phase one will get us to almost about 35,000 tons of capacity increase. But having said that, it is going to take a while to build the market and establish the quantities in the market. And the phase two would add between 10 to 15,000 tons. So altogether, about 50,000 tons is going to be added in phase one and phase two. This is going to be a combination of wire ropes and wires, and some plasticated LRTC also.
So this entire capex is in the value-added product. Am I right?
It is in the wire rope category, which means it is going to be a combination of GP ropes, crane ropes, plasticated ropes, fishing ropes, all the different categories of wire ropes. It would be a combination of different varieties of wire ropes.
Okay. So if we assume that we achieve the full utilization level post capex capacity in next 3 to 4 years, so what kind of margins that we can look at that point of time? Can you guide the trend that if we achieve so and so utilization level, so our fixed cost will come down, and with the much higher value-added product and the wire rope segment contribution, so that will lead to further improvement in the margin that we can see in next 3 to 4 years?
We hope so. Let's see. It has been a journey from 15 to 20%, and we would continue to focus in our journey to further build our value-added products and services and more focused on wire ropes. So I would not like to make any statement as to how, but I think definitely with the various initiatives and more focus on wire rope and value-added services, we would definitely move in the direction of taking it, maintaining it, and growing it steadily.
Okay, sir. Thank you so much and all the best.
Thank you. The next question is from the line of Gunjan Kabra from Niveshaay. Please go ahead.
Thank you for the opportunity and congratulations for a good set of numbers. So my first question is, I wanted to understand how is the competitive scenario in the Middle East region, the Saudi region as well. So considering a lot of expansions are happening in that region as well, and they're trying to gain market share. So what is the kind of competitive scenario with respect to other countries and their local companies as well?
We are our Brunton Wire, which is our subsidiary in Dubai, is the only wire rope producer in the GCC, in the entire Gulf region, and that has been there for quite some time. And with our local presence, we have a significant advantage of being local and being able to supply. Even the Saudi Arabian market, which is within the part of the GCC, is all encouraging local producers to come and local service providers to come by making investments and also having various policies which encourage the locals to come and thereby giving them an opportunity to gain market share and give various formulas where you are having local presence with local investments and local people to be able to get to higher market share with their important customers. So being the only producer, I would say that should give us an advantage being present in that market. And having said that, being such an important growth market, the whole world, whether it's the Koreans, the Chinese, the Europeans, everybody is looking at this as an opportune market to come in. So competition will be there. Having been present in this region from before will only help us to get a better positioning in that market.
Got it. And so the margin profile also in the Middle East, is it the same as the US or the Europe market? Or it's maybe slightly lower, or how is it?
It's pretty much similar in terms of the value-added products like crane ropes, mining ropes, and crane ropes, elevator ropes. These are fairly similar to what is there in Europe and US. And when it comes to GP ropes, it's a competitive market, and we all need to compete. And those, I would say, it is pretty much similar to the international markets. Everyone competes in every market together, so it's pretty similar, I would say.
Yeah, and just to add to that, in the Middle East, in terms of the GP ropes, there has been some pressure and more competition coming in with respect to GP ropes. So our strategy has been twofold again over there. One is we've added value-added services there, so rigging services as of last year in our Dubai plant. So that has helped us get closer to the customer and get higher margins in that sense. And secondly, again, our share of GP ropes has decreased, and our share of crane ropes and oil and offshore ropes, which are higher value, that has increased. So if I compare in FY23, GP ropes was maybe around 48 to 50% of the volume, which is now 36% for us in these 9 months. And at the same time, the crane and oil and offshore, which was about 47%, is now about 60%. So with the competitive dynamics at play right now and some pressure on GP, this twofold strategy has really helped us do really well in our Middle East subsidiary.
Got it. And in the European and the US market, the last quarter also we were discussing that there was a little slowdown in the European market, but the order book of Usha Martin was really strong. So right now also, I guess the market is little slow in the metal market in the European nation, at least it's a little slow. So how are we panning out there right now?
You see, Europe market overall, of course, is in the GP rope segment is slow. Basically, the general infrastructure growth in the European markets are definitely slow because of the high inflation and lower capex spend. But when it comes to these special ropes, particularly for the big projects, what we have been able to successfully build over the last through the Brunton Shaw network, be it on the fishing ropes, be it on the big oil and big ropes and the big projects which we have been able to successfully develop, those are continue to have the strong market, particularly in the oil offshore, fishing, and these sectors continue to show good growth, and we are getting good traction through these products. Having said that, I would say that Europe would overall continue to be a very important market for us, and with the good order book on these special ropes, we should be able to continue to do well in this market.
Okay. Okay. And in the US also, so we are supplying to the mining sector only, or where is the additional demand coming from? Which sector, I mean?
In the US, mining rope, definitely we had done some trial orders and those were successful, and we've gotten good feedback on the life of the ropes there, and we're getting repeat orders in mining. But other than that, we've also seen increase in the crane elevator market and also gondola rope market, which again is a high value product. So in that sense, again, compared to GP ropes, these high value products have done better for us in the US market. And from the US, we also cater to the South America market, right? So in South America as well, in the mining segment, we've done well in Chile, Peru, in the Colombia region as well. Even in the port segment in South America, we've got some traction and a good contract there. And then finally, the fishing rope business as well in Latin America has done pretty well. We've gotten some trial orders in Ecuador and even Brazil, South Chile. Slowly we're building up the market. I won't say, it's big bang, big orders there. Fishing rope, again, we get trial orders, we supply it successfully, and then, hopefully we get repeat orders in that sense. So overall, we would say a pretty positive outlook for the Americas region.
Got it. And one last question. Since this is a brownfield capex that we are doing right now, but any one-time expense that we'll have to incur in Q4 or Q1 for this capacity expansion?
Anirban, can you answer this question, please?
No, there are no one-time costs, Gunjan. So these are all... No, there are no separate one-time costs. What we put up in the range of the wave one capex is about 300 to 310 crores, and that takes care of all the costs that we have estimated.
Got it. Okay. Thank you so much, and good luck to the entire team.
Thank you.
Thank you. The next question is from the line of Sanjay Shah from KSA Securities. Please go ahead. Sanjay, the line for you has been unmuted. You may proceed with your question. As there's no response, we will move to the next question, which will be from the line of Jatin from Invest Savvy Portfolio Management. Please go ahead.
What we wanted to know was that while you have managed the profitability despite movement in steel prices going lower, if the steel prices trend were to reverse, does that help your business generate more EBITDA?
No, I think our wire rope business, we have made it a value-driven business where we have been able to protect our margins, be it in a downward steel market and an upward steel market. And I think that is something which we have worked hard and built a strong product portfolio backed with service, which would help us to maintain margins both in a little volatile market also. And that is a model we would like to work, and that is how we have been able to build our relationship with our customers. It is not based on steel price increase or decrease. It's a value protection which we are able to do. So
price is passed on, price with volatility is passed on to the customer.
Yeah, more or less we have been able to work it in a model where we have insulated our business from going up or down. So I would not say when it goes down we will gain profit, or when it goes up we will lose. So we have been able to work on the wire rope side. When it comes to LRPC and wires, it is a pass-through. When it goes up or goes down, it is generally factored into the monthly pricing.
Okay, and what is your outlook for, profit, this prices of steel going forward, or it's too volatile for you to take a call? Let's say next 1 year, what is your sense of how it goes, especially for the LRPC business?
It's for LRPC, it's all pass through. So whether the volume prices come down, the LRPC within a month accepts the same price and reverse on the other side. For me to forecast on how the steel prices would move in the next 1 year is difficult. And I would, we are no more in the steel business for us to comment on the steel prices.
Oh, that's okay. If it's total pass through, then that is fine. And in terms of some guidance on where you see your let's say steady case operating margin percentages ending, because we've seen a concerted effort to move the operating margins up from around 14, 15, 16% to close to 18 to 20% now. Do you see any further growth of this going up in steady state, or you think that we've mostly reached where you would want to be in the long run?
This is something which is a constant focus of the management to continuously keep on improving. As we had said that we would gradually keep on pushing the value-added products, and that is something which, and the services. So that has helped us to come so far. We feel that our effort is going to be further continuing, including the new capex which we are adding in our manufacturing facilities in India, whether it is the value-added LRPC. So our continuous effort would be to see that how we continuously improve our margins. And the effort, let's see how far it is able to help us manage it. Hopefully it should be better.
But what would your, say, steady state target be? While obviously it would be good to go beyond that aspiration, but what would be a target where you'd say that it would start getting, even with all the things, you would be happy with it kind of stabilizing at those levels?
And these levels are good, and let's see. It's difficult in our business. A lot of things depend on the product mix, which segment is getting you better revenues, how the Saudi Arabian market will span up, how our other initiatives will come. Our endeavor is to see that whatever we have achieved, try to maintain that and see that how we can improve on it. So, even in the journey when it was 15%, I was reluctant to commit because the initiatives are there, but it takes a while to get you to these levels. I can only say that our entire management team across the globe is focusing more on value-added products and services, which will enable us to get to that. But it is hard to give a particular number that this is something which we'll do. And you should see the track record in which we have been able to build. And I'm sure that our team will continue to further focus to improving it, but not need to commit on it at the moment.
So let me just, one last question. If I were to ask you, what are the two things you are most looking forward to or excited about in your company growing, and what are the two things which you would say kind of are concern areas for you going forward? So like two things maybe which would keep you awake at night, and two things which you are most excited about.
Let me tell you on the risk side, I feel we have a large volume of LRPC, and we have seen a steady decline of margins. So that is something which is in the overall volume is significant, and that is something which is definitely a matter of concern. And I don't see that improving in the near future based on what the market dynamics I see. That is point number one. Point number two is the logistics issue, the global logistics challenges because of the Red Sea and the Middle East geopolitics. I think the global two things are going to get affected. One is the transit time to our destinations, whether it's in Europe and US, would go up by at least 15 to 20 days, or almost 30% more time than what it usually takes. Also, it is going to incur higher freight. Having said that, this is going to be not only for us, but for all the Koreans, Chinese, Malaysians, anybody is supplying into these markets. Our endeavor would be to push the cost increase to the customers. But that is one part, and that is something which we had done in the past also during the pandemic when the logistics went haywire. So this is of course a challenge which has come in the last 2-3 months. Secondly, it is going to definitely create a situation where there could be increased working capital needs because of the increased transit times in our business. So that is something till in the near future. So these are the two negative worrying things, I would say, glaring worrying things. On the positive side, really looking at the Saudi Arabian market, which is, I feel, one of the fastest growing markets in a GCC country, as well as probably one of the markets which everybody is looking at a growth in the near future. Secondly, our foray into synthetic slings, a part of our Brunton Shaw manufacturing plants initiative to get into high value-added synthetic slings, which of course we are investing about 4 to 4.5 million pounds sterling, or say about $5.5 million into this. That is something I am excited about, and that is something which is a first foray into synthetics for the company. This has got high-end and it is complementing our wire rope businesses where our services industry works on it. And I feel if this is something which can really build into a good revenue and profit models in 2 to 3 years' time.
So there's no concern on that case which was mentioned, some ED issue as well as some hearing on 20th, which is there. There's some mention of.
These are sub judice matters, and I would rather not comment on those at the moment.
But those are not.
But I can tell you, not impacting the performance of the company.
Okay. Thank you. Thanks a lot, sir.
Thank you. Ladies and gentlemen, to ensure that our management is able to address questions from all participants in the conference, we request you to please restrict your questions to 2 per person. You may rejoin the queue for follow-up questions. We have the next question from the line of Sonal Minhas from Prescient Cap Investment Advisors. Please go ahead.
Hi, sir. This is Sonal Minhas. Am I audible?
Yes, sir, you are audible.
Yes.
Sure. Okay. My first question is regarding the expansion plan that you've summarized. So, 2 parts to it. First one, by when do we expect the phase 1 and phase 2, roughly broader timelines, to be over? That's the first part. And secondly, you mentioned that the cumulative capacity we are adding roughly is between 45K to 50K tons. So, is it fair and simplified to assume that if we are selling roughly 190 odd K tons a year, we are adding capacity to build up sales to go up by roughly 25% from here on?
To answer your first question, the phase 1 capacity expansion is completing in Q4, that is in the month of February, March this year. And the phase 2 would be in another 18 months from now. Various initiatives of the capex ordering has already been done for the phase 2. Quite a large portion is from imported equipment, so that is going to come more towards the fourth quarter of the next financial year, of this financial year. Coming to, yes, the volume is expected to, the capacity addition is close to 50,000 tons. And our endeavor would be to push these volumes. Since these are all technical products with value-added services, we would start getting the benefits from this from quarter 1 of this year. But it is going to take the ramp up, including the marketing and the repeat orders, and increasing the market share, including the initiatives which we mentioned about Saudi Arabia and also integrating with our other international subsidiaries, will take some time. But overall, our endeavor would be to get to these levels of the capacity increase in over the next few quarters.
Understand that. So is it fair to assume that, given that it's a value-added product and we're entering through geographies, that if, let's say, we achieve the potential and the capacity, we're looking at us maybe utilizing the best of this capacity over the next 36 odd months, right? Roughly, basically, that's where we are, if I'm not wrong.
We would push it very hard, and our international subsidiaries as well as the various initiatives are there. We also need to understand how the various economies, because 55% of revenue comes from our international businesses. Whereas some good it is from Saudi Arabia, Middle East, which are growing markets. Europe in certain sectors doing well, certain sectors are still slow. America, certain growth, particularly on the specialized products, what Shreya mentioned, is doing well. We overall expect that we should be able to get to those increased volumes over the next, I would say 2 to 3, next 2 years, we should be able to fully stabilize the market. What we don't want to do is push the prices down, because that is something which is going to impact the existing margins also. It's been a tough journey for us to take it to these levels. So we would develop these markets. We don't want to go and push and get into the lowest end of the markets and get capacity. We would gradually push it up and make sure that the top line and the bottom line steadily grows with us.
I appreciate that. So, sir, coming to that point itself, any demand outlook triggers, like what you mentioned about the Middle East, any demand outlook triggers which you talk about, let's say, India and America, by and large, assuming there is an infrastructure push in America, there is some similar push in India. If you could just highlight a little bit about what's real, what's not, what is falling in your around your area of expertise, that will be helpful to just understand these markets. Because sitting here in India, we are really opaque to these. How much of that falls into the relevant sector?
See, India is a very strong market, and we have seen that growing. And we have a 60-70% market share in India. So we will grow with whatever the growth at which India grows. There is a big project of the Parvatmala project, which the government has announced, which is going to have big ropeways coming up. So that is also going to help us. And we are in touch with all the authorities, and there is a good potential for these projects coming up for the various, and all of these require wire ropes. Also, there are big infrastructure projects coming up, big highways, railways, these high-speed railway projects, where there would be good demand of plasticated and galvanized LRPC. So I'm sure that that side of the market should do well. And overall growth of India, if it does at the current level, even our share keeping our share at 67% we would continue to grow at the same pace in India. It won't be possible to increase the market share. Having said that, Europe, US, our market share, particularly US, is very low. We are at only 2 to 3% market share. And with the growth opportunities in the US and the various teams which we have augmented there, I feel the volume growth will come from Europe, US, Saudi Arabia, Middle East, and even some parts in Southeast Asia, particularly Vietnam, Indonesia. These will also continue to grow and add volumes and value to our business.
I understand that, sir. Thanks a lot, sir. I'll fall back in the queue. I have no questions. Thank you.
Thank you. Ladies and gentlemen, we will take that as our last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
I would like to thank everyone for attending this call and showing interest in Usha Martin Limited. I hope we have been able to answer all your questions. The company is dedicated to creating value for all its stakeholders in a sustainable manner. Should you need any further clarification or would you like to know more about the company, please feel free to reach out to us or to CDR India. Thank you once again for taking the time to join us on this call, and see you all in the next quarter. Thank you.
Thank you. On behalf of Usha Martin Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.